Good morning, everyone. Just give me 1 minute. We're just having a little bit of technical difficulties. Give me 1 second. Okay, because we're having some technical difficulties, we're just going to use a static report to help you walk through our views of the market. But essentially, what we're seeing here this week was the optimism around last week's reopening clearly is not lasting at all. Last week, we had the optimism around the reopening that pretty much changed market sentiment to the positive. But then we had concerns towards the end of last week with regards to just these pace and speed at which these major tech firms have been spending to dominate AI. And largely, the gains on the S&P 500 over the last 2 years have the majority of the gains in corporate profits have come from these major tech companies. So there's a lot of parallels that people are kind of trying to draw between the AI hype and the dot-com boom. But there is a difference here from the perspective of, these companies are spending tens of billions of dollars a year in capital expenditure to build out compute for AI. But the difference here is that these companies are hugely profitable. They have tons of cash, and they have the money to spend. The question is whether or not they're going to get their return on investment. And at the moment, there is not a clear path that they are going to get their return on investment. And that is what investors are questioning. So on one hand, you have a lot of parallels to the dot-com boom, where you have a huge amount of market cap that is being assigned to the future potential of AI, which I think we all agree has the potential to be huge. But exactly who's going to be a winner? How is that going to be? How is money going to be made by AI? Or which companies are going to make the money from AI is at this moment still very unclear. And that is what investors have clearly over the last 3 or 4 trading sessions have become more and more concerned about. Right now we have both the S&P 500 and the Nasdaq 100 breaking below the 50-day moving average. That is a huge concern from my perspective to see that downside. Because now that the S&P and the Nasdaq 100 have all broken below that major support level, that is really what opens up potentially for some downside potential here in the overall markets. If you look at the S&P 500 with the 50-day moving average overlaid on it, as you can see, we have just closed below that 50-day moving average here over the last couple of trading sessions. So Monday, we opened up above it, and by the time we closed it, we were below it. This is the first time we've seen the S&P 500 close below the 50-day moving average since February of this year. The markets had a bit of a sell-off here going into the Liberation Day earlier this year, but we have stayed above the 50-day moving average basically since May. So this is the first sign that we're getting some cracks, even from the major equity indices. If you look at the Qs, let me go back. If we look at the NASDAQ 100, you see the same thing. We closed below the 50-day moving average as of yesterday. So things are starting to get a little bit worse. If you look at small caps, IWM, small caps, last week we talked about the fact that we already broke below and that there was a risk that this can start moving lower. So we didn't break below. It tried to get back above it, and now it's broken below. So this is a pretty negative sign, in my opinion, that small caps have tried to get back above the 50-day moving average, has now turned below the 50-day moving average, and the moving average has now turned negative. Look at MACD. MACD, both MACD line and the signal line are now negative. This is not a good sign here for the equity markets at the moment. If you look at RSP, the equal weight S&P 500 index, same thing. Not only have we broken below the 50-day moving average, we've also broken below this 185 support level. This is a level that is pretty important going back all the way through the entire summer, the beginning of summer at July, right? So we kind of got above 185. We've spent a lot of time kind of sitting above 185, even though during that time, the relative performance of the rest of the market is underperforming the growth side of the market. But now we're starting to see cracks basically form all over the place, even in the major equity indices. And that is the first sign that bulls are losing control here of this market. If you look at bonds, not only looking at equities, if you look at bonds, HYG also closed below the 50-day moving average after what has been a period of essentially no growth by high yield corporate bonds for the last, call it 3 months or so. And even if you look at treasuries, we've seen treasuries continue to sell off here recently in the last couple of weeks, which is concerning because if you look at kind of the 10-year yields, 10-year yields are back, around 4.1%. So this is continuing to put a bit of stress here on what we consider typically the zombie companies that do not generate enough revenue to offset, do not generate enough earnings to offset their interest payments. So these are companies that are at risk of default and bankruptcy. And we are now seeing over 1,000 companies that are publicly traded that fall under that particular category. Now, these are relatively small companies compared to from a market cap perspective. So their overall influence and weight on the overall market is small in relative terms. But when you have more and more bankruptcies, that's never a good sign here for the U.S. economy, especially as consumer spending, even though on paper seemingly is holding up, it's clear that when you look underneath the surface, consumer spending is becoming more and more driven by a smaller and smaller population of the population. You have high income earners that are outspending lower income earners by a pretty wide margin, and it's getting wider. And that gap between how much money the high income spenders are spending versus low income spenders is really what concerns me with the overall market, especially if you consider the fact that the labor market has continued to weaken here for the last 6 months. We are expecting to get a labor market reading on Thursday of this week. Now that the government has reopened, the delayed in that data is coming out this Thursday that we were meant to get a few weeks ago. So we'll get a glimpse into what the labor market looked like in October. And then we'll get another reading of that in the beginning of December for November before the next Fed meeting. And I think those are some of the things that are really important to be paying attention to here right now. There definitely is more risk to the downside than to the upside. So looking at kind of opportunities here in the market, the first one I want to take a look at here is NVIDIA. NVIDIA reports earnings on Wednesday. And note that NVIDIA has pulled back to the 50-day moving average, but so far has held that level. I think that NVIDIA still represents an upside opportunity for long-term investors. And this is rooted in the fact that if you look at NVIDIA, it's trading at around 28 times forward earnings, which is not cheap. But if you look at the growth expectations for NVIDIA, if you look at how profitable they are, we're talking about a company that is head and shoulders ahead of its peers from a profitability perspective and from a growth perspective. Yet it trades at nearly the same valuation as the entire semiconductor industry. The median valuation of the semiconductor stock right now is trading at around 26.5 times forward earnings. NVIDIA is around 28 times forward earnings. So we're talking about a stock that's trading marginally higher than the rest of the industry, even though it is by far the leader across the entire board by a pretty wide margin. And that's why I think even though NVIDIA has pulled back, that pullback actually represents a long-term opportunity for buyers. The next one I'm going to take a look at here is FedEx. FedEx, as you can see here, over the last, call it the better part of this year, has really kind of been forming this major bottom, and just last month started to break out here. So not only has it broken out and moved higher here, note that it's outperforming the S&P 500. That's a really good sign when something breaks out and it outperforms the market after it breaks out. So this is really where we think the upside potential here for FedEx looks quite promising. And this is also rooted in valuations. FedEx trading at 14, call it 15 times forward earnings, while the industry is closer around 19. So you're talking about at least a 25 to 30% discount to its peers, even though the stock is growing just as fast as the transportation industry, and it's just as profitable as any other stock in the transportation industry. So the fact that it trades at a 25 to 30% discount represents that upside opportunity here for FedEx. The other one I want to take a look at here is Gilead Healthcare. We see that healthcare remains defensive here. Note that as the S&P 500 is starting to pull back here, stocks like Gilead are actually making 52-week highs. That defensive nature of the healthcare industry, you add on top of that the fact that Gilead looks quite attractive from a valuation perspective, makes it look quite interesting. They are trading at around 14 and a half times forward earnings, which is in line with the entire industry of 14 times. But they're expected to grow much faster than its peers. And more importantly, it's more profitable than its peers. So the fact that it trades at the same valuation as the rest of the drug manufacturers, but is growing faster and is more profitable, leads me to believe that there's still upside opportunity here for Gilead, even though the overall market is looking weaker. Healthcare is seen as being more defensive, and we're seeing that play to the benefit of drug manufacturers like Gilead. The next one I want to take a look at here is Pacific Gas and Electric. Pacific Gas and Electric, as you can see, this is a stock that recently broke out above that 15.5 resistance level, pulled back, started to bounce higher here. What we're really looking for is that breakout here above 17. We're looking for that breakout here above 17, but the stock has outperformed the S&P 500 since it's broken out from that $15.5 level. And what looks quite attractive about this particular stock is that Pacific Gas and Electric is trading at 10 times forward earnings. That's a nearly 50% discount to its peers. And it's expected to grow just as fast as its peers. The one thing that Pacific Gas and Electric, and the reason why it trades at a lower valuation, is because it's not as profitable. But net margins are 11% versus 15% for the industry. So it is a little bit behind from a profitability perspective, but I don't think that it is so far behind it justifies a 50% haircut to its valuation. And that's why Pacific Gas and Electric is one that I believe has the potential to break out above 17 and continue moving higher, especially as the market gets more defensive and scales out of tech names into and into more defensive sectors like healthcare and utilities. The next one I want to take a look at here is Alphabet. Alphabet, as you can see, continues to move higher here and has just made a new 52-week high yesterday, continues to outperform the S&P 500. And Alphabet, within the AI opportunities, I think looks like it's one of the more attractive ones because it's only trading at around 24 times forward earnings, which is not much higher than the average S&P 500 stock, but it's expected to grow quite substantially. We're talking about EPS and revenue growth that's in the 13 to 16% year over year range, which is very respectable growth for a company of its size. And then more importantly, from a profitability perspective, net margins that are in the 33% range. So there are very few companies outside of the only company I can think of is Meta that grows just as fast, is just as profitable, that's trading at a valuation that's either equal to Alphabet or lower than Alphabet. So Alphabet, I think, trades at an incredibly compelling valuation for the growth and profitability metrics for this particular stock. And then the and then from both Alphabet and Meta, I think, are in the same boat. Is that if you are interested in investing in AI in the long run, that these are both opportunities that are worth looking at least from a valuation perspective, outside of NVIDIA. NVIDIA is obviously a different type of investment because you're investing in the semiconductors that power this, versus Alphabet and Meta are the software products that provide the services for end users. So both of them are opportunities, in my opinion. And I'll leave you with one last one, which is Micron. Micron, as you can see, also yesterday made a new 52-week high and has continued to outperform the S&P 500 by a very wide margin over the last few months. Micron, despite this huge run up in the last few months, is still only trading at less than 15 times forward earnings. If you look at growth expectations, you are starting to touch the realms of NVIDIA. We're talking about EPS and revenue growth that's in the 25 to 35% range. NVIDIA is still a little bit higher than that, but we're in the same realm as NVIDIA in terms of growth expectations. Net margins are much higher than the industry. It's not quite NVIDIA margins. It's 23% net margins versus 52 for NVIDIA. So it's not nearly as profitable as NVIDIA, but it is growing almost as fast as NVIDIA. It is far more profitable than the semiconductor industry, yet it only trades at 14 times forward earnings. When we first started talking about Micron back here in the low 90s, the stock was trading at around 9 times forward earnings. So the stock has had a very nice run since then. It's expanded its multiples by a pretty significant margin from 9 times to 14 times. But I still think that there's plenty of room to run because it's only trading at 14 times forward earnings versus, the 26 times forward earnings that the industry is trading at. Now, we could argue that the industry is perhaps a little overvalued and that we're going to start to see some multiple contraction here over the next few quarters, especially if investors continue to be concerned around the spend of AI. But, that still gives Micron quite a bit of upside potential here for Micron. Now, that covers kind of the bullish scenarios that we're looking at. We also see quite a few bearish scenarios at the moment. The first one I want to take a look at here is Crown Castle. Crown Castle, as you can see, this $92 level has been a pretty important level all year round as support, and now more importantly as resistance. This $92 level, it's come back and it's gotten rejected at that level, and this is really where I think there's the potential for some further downside here. Crown Castle is trading at 18 times funds from operations. We use funds from operations for REITs. We don't use PE for REITs. We use funds from operations for PE. It's trading at 18 times funds from operations versus the industry's around 15. So it's about 20% overvalued relative to the industry. And what Crown Castle, in my opinion, the reason that I have a bearish view on it is that Crown Castle has negative revenue growth, meaning its revenues are expected to decline about 11% year over year. Nothing good comes out of a company that's expecting revenue declines. And especially if you add on top of the fact that they're losing money for every dollar they make in revenue. So declining revenues, not profitable, you have the recipe for what I believe is further downside. So the fact that it broke below 92 shows us that the timing on this looks particularly strong to add some bearish exposure here for Crown Castle. The next one I'll take a look at here is Affirm Holdings. Whoops. Affirm Holdings, as you can see, this is recently kind of testing the $70 level also and is starting to break below that level. And this is really where I think the downside potential here after this, you call it a topping formation, is starting to break down here to the downside. A firm trades at nearly 80 times forward earnings, 80 times. The industry median for this particular space is around 23 times. So it's trading at a valuation that's nearly quadruple its peers. Now, it is growing pretty fast. It's growing revenues in the 25% range. It's growing EPS in the 100% range. So, you could argue that it's justified that it has a high valuation. But the problem that I have with it is that a firm operates on thin margins. We're talking about 6% net profit margins. So you can grow very fast, but if you operate on very thin margins, it doesn't give you the ability to command such tall valuations. And then you add on top of the fact that a firm caters to generally lower income, lower credit quality borrowers. And when markets get stressed, firms like this have to tighten up borrowing standards to make sure that loan losses don't get out of hand. And that's going to significantly reduce revenue and earnings potential, on top of the fact that it's going to compress margins when loan losses get ticks higher. So this is all kind of having the recipes for what could be a slowdown in this particular stock and a breakdown below 70. And I think the timing on it makes sense to add some bearish exposure here for a firm. The next one I want to take a look at here is microchip. And we've talked about this here in the last few weeks. And we talked about it last week when it broke down below 60. Now that it kind of tried to recover a little bit, the stock is continuing to break down. Microchip is trading at 37 times forward earnings. When we first started talking about this, the stock was trading around 45 times forward earnings. So it's come down a little bit, but it's still well ahead of its peers. And you can sort of justify a slightly higher multiple because it grows faster than its peers. But the problem with microchip is that it's not profitable. For every $1 they generate in revenue, they're losing 4 cents in net loss on that company. So when you have a company that's not profitable, that's really where I think it has the potential of really falling apart in a market that's getting stressed and being concerned about valuations. Another one, I've been talking about this for a few weeks now, is Apple. Apple, as you can see, made this double top here at 275. And I think that's a signal that Apple could potentially be on track for what could be some downside here. As you can see, we're just trading up against this trend line here. So we could see Apple continue to move higher from here and bounce off. But my hunch is that it's more likely to break below that trend line and trade back down to, let's say, 245 as an initial target here. Because Apple trades at 33 times forward earnings. That's 50% higher than its peers. It's not expected to grow any faster. It's actually expected to grow slower than its peers. And the only thing holding up Apple is the fact that net margins are around 26%, which is significantly higher than its peers. But this is really where I feel Apple is starting to unravel a little bit with regards to their ability to continue to hold their margins, especially as growth continues to slow down for this particular stock. So the fact that it trades at a 50% premium to its peers is what leads me to believe that there's some downside risks. The next one I'm going to take a look at here is Dutch Bros. We've talked about this here in the last few weeks. This fact that it kind of tried to break back above 57.5 and has failed multiple times leads me to believe that there's further downside. Dutch Bros trades at 60 times forward earnings. That's nearly triple the industry average. And yes, it's expected to grow much faster than the restaurant industry. But the problem is that net margins are very thin for this company. It's 4% versus around 12% for the restaurant industry. So you can grow very fast, but if you're not profitable, or if you operate on very thin margins, that's a recipe for some potential disaster in this type of market environment. And the last one I'll leave you with is Spotify. Spotify, as you can see, has really tried to hold on to this 660 level here. But so far, we've kind of broken down below it. It's come back to retest this level as support. as resistance, and I think that we're more likely to see some further downside. As you can see, the stock has underperformed the S&P 500 by a very wide margin over the last 4 months or so. And I think that the downside exposure here for Spotify is pretty significant, especially since it trades at 45 times forward earnings. So really expensive stock from a valuation perspective. And the biggest concern that I have with Spotify is that net margins are pretty thin at only 8%. So they're not particularly profitable. Um, and when you have a market that's starting to be a little bit more concerned about valuations, that's really the type of company that I think will have a target on its back and potentially underperform. So that is a summary of where we currently stand. It looks like equity markets are starting to show some major cracks with the S&P and the Nasdaq both below the 50-day moving average. So be very careful. Be a lot more cautious in this type of market environment, especially since small caps and the rest of the market have already broken below those levels a couple of weeks ago and have continued to weaken from there. So keep your eyes out, and I think that there's going to be a lot more bearish opportunities in the short run, and then far more limited bullish opportunities in the market. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.